Moving on to the short strangle. I like the strangle a little bit more. It gives you a little bit more wiggle room. Although you don't collect as much in premium, you have less risk. Obviously, the less risk you have, the less premium you are going to receive. But your probability of profit increases, which is why I kind of like the strangle. I also like using the charts to figure out where there's support and resistances, and then use a strangle strategy to kind of encompass where I think those support and resistances are. Support is a bottom or a line that would support stock prices, and the resistance is the line where one would show resistance, or the stock doesn't really want to go through this. And a short strangle, again, is a naked strategy, and we want this in a environment where there is very little volatility. We want this to kind of trade sideways throughout the time that we're holding this option. We don't want to see it spike up or spike down. We definitely would not really want to put this strategy on right before earnings. For one, we want to use this in low volatility environments, so that would not be conducive to a major move. And remember, like I said, it's a market neutral strategy. We're going to sell an out-of-the-money call and an out-of-the-money put simultaneously. The short strangle, the seller of the strangle is looking for the underlying to trade at a price that is between the call and the put at expiration, thus having both options expire worthless. That would be the ultimate goal. You know, whereas in the straddle we're trying to pin it, here we're getting a little bit more wiggle room. The max profit on the short strangle is the net premium received when both options expire worthless. And we will go over a chart at the end here. But the net premium received when both options expire worthless, we want the underlying to be trading in that range. The max loss on this, again, remember there's unlimited loss possibilities because there's no defined risk here, and there are always going to be two possibilities. The price of the underlying minus the short call minus the net premium received is your max loss for the call side. For the put side, it's equal to the short put minus the price of the underlying and minus the premium received. The break even for the call side is going to be the short call plus the premium received, and the break even for the put side is going to be the short put minus the premium received. Now we'll go over a chart here. You can see here in this chart we have a little bit different look than we had for the straddle. We have a flat top or a mesa type structure, I guess, if you will. But as you can see, we have the very middle is where eBay is currently trading at right around $60 a share, and we have wiggle room on this. I put this in at a 62.5 call and a 57.5 put, where I'm selling those. So you can see on the right is the calls, and on the left side of the middle is the put side, and where it crosses the dotted line is our break even. So we have a lot more room, but as you can see, our credit received down here is only $2, so about half of what we receive for the straddle. But having said that, we have a lot less risk. As you can see, we are still making money outside of one standard deviation move, which I will go into that later in the classes and the webinars as to why we would pick one standard deviation, and I'll go over that a little bit more in the video tutorials later.